Good. Hi, hello. So, nice to meet you guys. If you don't know already, my name is Johnny Chang, and I'm the VP of Market Research and Analytics here for the Personal Portfolio Management Club. And today, we're just going to go over a really basic intro to investing strategy, because when we asked for feedback from you guys, we learned that a lot of you guys just want to know like how to get started and what to do when you want to start investing. So we thought that we put together today's presentation to kind of get people in the space of what it means to open a brokerage account, what to look for in stocks, and tips and tricks about how to stay diversified or have good risk management. So we have planned right now a really fun icebreaker. So this consists of 2 5-minute rounds. Everybody's gonna start with some Monopoly money and some shares, $72 and a couple shares of stock. And so the rules are, as soon as any 2 people agree on the trade at any given time, the price is locked in at whatever it is. And you might be asking, what is this about? So I kind of vibe coded a stock market simulation, and we're gonna be simulating what it's like to be on like a New York stock exchange floor. Like all the chaos and prices going up and down and trying to make money. Sorry. So you can only buy shares with cash, and you can only sell shares to get cash. So no like share for share transactions, no like, I mean I guess you can kind of have some like corruption and like bribery, but none of that in our stock exchange, right? So your objective is to have the highest net worth by the end of both rounds. And your net worth will be equal to your cash, total cash plus the total value of your positions. So right now we're just gonna give everybody some cash and shares.
It's not real money.
It's not real money. This is just a simulation. Like for anybody who has never invested before, just like a real fun experience to try to see who can make the most money in the big stock market.
3 trillion.
So I have right here. We have 7 different companies.
How much money can each person get?
72. I mean, it's arbitrary number. So yeah, we got all these. Anybody know what this group of companies are called?
Mag 7.
Yeah, Mag 7. So some really big companies. Google recently hit $3 trillion in market cap, which is
I saw that, yeah. There's what, 4 companies that are 3 trillion plus now?
yeah.
Yep.
So this is like the first time I'm trying this out. So let us know like any feedback, anything we can improve. Yeah.
One
I think
more.
it's magnificent.
One more?
You just split it, I guess.
That's better over
Sorry.
You can get
Oh.
Feel free to like buy into the
We
chaos.
already have the shares.
Shout out. Like,
We already have the-
anybody have any
Oh, yeah, we have-
Tesla shares?
Oh.
Like,
Can you demo how this is supposed to go?
Okay, so I'll show you. So when I start the simulation and I say go,
Yeah.
each stock ticker will have like shifting prices, right?
Okay.
And your goal is to try to make the most money at the end of 5 minutes. And so just you're like trading amongst yourselves. Like you have to find other people who have certain shares, and then buy those shares, sell shares, and at the end we're gonna count up how much is your net worth, which is your total cash plus the total value of all your positions.
Or if you don't like any of the stocks, you can just hold the $72 and pray.
Yeah.
Don't
There's a
recommend
couple
that.
strategies you can go with. You can try to like diversify, get one of each company, go all in on one company, like hold cash or something. And so there's 2 rounds, and in this second round, there'll be more elements introduced that make it more realistic. So this is just the first round.
You can like trade like stocks with another stock, not just cash.
No, I just didn't do that. only stocks for cash
I
and
do.
cash.
Yeah.
How do we know how much a stock costs?
So at the top here, you get
Oh,
yeah.
Oh,
Alright,
no,
do you have money?
I have 62.
You know Johnny
I'm missing $10, yeah.
Is there any $1?
Alright, should we start?
Okay.
No, no.
Alright, how long are we gonna do this?
I should have
You
known.
were like 3 minutes.
I think like 5.
So everyone's gonna be having like
Well, okay, yeah. Like everybody can get up and like walk around. Yeah, walk around, get up, start talking. Like meet new people too. Alright, ready? Alright, we're gonna start. Wait, anybody got a timer? Ready? For like 5 minutes. Yeah, 5 minutes.
Johnny,
Alright,
do you have 2 shares?
was it?
Do you get like you share?
Yeah.
Oh, I didn't get one.
He's here. You take one of mine.
Oh,
Yeah, you're supposed to get 3 each.
oh, I have 1. You get 3 each? Oh, shit. I'll take Google.
You take Google. Wait, anybody have any Tesla? Tesla for $2, right? Okay, I'm logging that in. You have $3? I'll buy it for $2. Thank you. Anybody have any Amazon?
Wait, so do we have it? So do we just try to like share, like buy?
Yeah, buy shares from other people. Well, you have to have the most money. Do you have any Microsoft? I buy Microsoft. Anybody who's willing to buy Tesla? Anybody willing to buy Tesla? $70? Who wants Tesla? 10? Okay, I'll take it. Anybody have any Amazon? I'll buy some Amazon. Anybody want any Nvidia? I got Nvidia. Who wants to buy Nvidia? Anybody want to buy some? Anybody have any Microsoft? I buy some Microsoft. Microsoft, $6. Oh wait, I get I'll give you a 5 and you give me thank you. Okay, anybody have any Amazon? Oh no. Anybody want to buy like a Microsoft?
I'll buy Amazon back from you.
Agreement 10? 2?
Okay, I'll give you 5. What about 5? Say $2. I'm giving you $2. I'll give you $5.
Anybody want any video? Oh my god. Yeah, the second round's 11. Okay.
Microsoft or do you have?
I'll be Microsoft for 7. 7? 5. There you go. Thank you. Hey. Yeah. Anybody want any videos? That 11 cents. 11. I'm taking video apart. I'm good for 7. I mean, you say 6 hours. But I'll give you.
Yo, Meta. Anyone Meta?
Anybody have any Google? I'll pay $5 to Google.
I'll give you $10 for it.
$5?
So, 11. I have Microsoft, Tesla,
The stock market just crashed.
It's okay.
Here you go.
Anyone have Apple or
Just
Nvidia?
keep like keeping up. I don't know.
You selling Apple or Nvidia?
Yeah. I'll buy
I have two.
Any Apple?
Someone
I'll buy Microsoft. Anybody have Microsoft?
Nvidia. Get rid of Nvidia stock now, guys. It's
I'll buy Apple. Yeah. $10 for us. Sabina, I'll buy Nvidia from you. It's at 5. I'll take it. No?
I'm okay.
For Apple?
You guys want to buy something? Amazon's crazy. It's like $19.
Anybody? I'll buy Google. Anybody have Google?
Apple. You guys get Apple?
I'll buy Amazon. I'll buy Amazon and Nvidia. I'll buy Nvidia.
Yeah, Microsoft for 30. Yeah.
Can I buy some? Can I buy some?
Yo, Nvidia. Apple.
Trash.
We can buy my.
Oh, yeah, I'm sorry. I just forgot.
No, you're okay.
Because like,
One minute warning. No, 5 minutes. 5 minutes. No. 5 minutes.
No. Wait, scroll down to the deposit. Oh, these are the final share prices we share with.
You have to go.
Okay.
Apple and Microsoft.
Okay, everybody,
Count up your total.
yeah, count up all your like cash and like calculate. Anybody need?
It's like 20 minutes away. Yeah, it's not that far. Are you from St. Louis?
Yeah, I know. You can move here or?
I used to, and now we're roommates, so we live at
Everybody
West
count
Palm.
up all your cash and all your
I used to make it here freshman year. It was rough.
Oh,
I get it. Yeah, I feel like it's hard making friends freshman year. Like
There's a round two, so don't worry. Yeah.
Yeah, I feel like it's hard.
Add more elements to the round two. There's like has like a gold market, bear market.
Yeah. Aw, that's good.
Alright, so everyone totaled up the numbers?
Yeah.
Alright, raise your hand if you have above like 70. Okay, 80? 90?
Oh, you're in. Good one. I didn't even count mine.
110? 2?
Okay, what do you guys have? How much is the value?
I have 124.
I got 112.
Wait,
Whoa.
both at 124?
Okay, so
Okay.
can anybody just like tell us what your net worth was and what was your strategy?
Wait, do we add our stocks or just?
Yeah.
Yeah, you got the stock.
Add the stocks.
Yeah, so like how many shares times the number of what the price was, and then add that to how much cash you have.
12.
Oh, wait, no.
I bought it.
So the people who like had the two highest net worth, what was your guys' strategy?
Oh, I was just looking at the fluctuation. Let's
Yeah.
say, Microsoft, I bought it from him. It was at $5. I bought it for. As soon as the stock, I was looking at the lowest stock and trying to buy it for like $3,
Okay,
$4.
so buy low, sell high.
Yeah. And it's gonna be up at more than like 3 or 4.
Any other like different strategies that we had in here?
I just sold all my stock at the beginning.
Yeah.
I was a little bullish. I mean, I don't know how like this is programmed, but like if the stock was selling at like $5 per second for it.
Oh, okay.
I don't know.
Like paying a premium.
Right.
Alright, so we got a round two. And so it'll be a bit slower, so the tickers like won't like be exchanging so fast. But I've introduced a type of market. So it could be a bear market, a bull market, but you won't be able to tell, so I'm gonna keep it hidden.
Oh, yeah.
So you have to decipher from the stock patterns whether we're in a bull market or bear market. And I'll give us another 5 minutes, and we'll see if we can get some new highest net worth people like Elon Musk. Alright, and the range is from 0 to 25. So, okay. We got the time ready?
Yeah.
Can you see the like stock prices?
How much time?
Yeah, I'm just gonna hold.
It's 5 minutes, 5 minutes. Anybody have any tests?
All the colors of
I'll let them test it. What do you have to do? Amazon? I'll buy a video. $9? $9? No. $7? What do you have?
Look at the.
$10? Okay, I'll do 10. Yeah.
Huh?
I'll buy Tesla until 11.
I'll buy this one.
All the stocks are moving together. Oh, he wants to buy some Nvidia for $20.
Okay, anybody have any Amazon?
I like Oh, I'll buy some Tesla.
Tesla?
Yeah, Tesla. Any Tesla?
Yeah.
I bought both for like over
Oh,
18?
Oh wait.
17?
Uh,
18? 23?
I'm broke. I'm broke.
Gotta make a deal now.
What do you have in here?
Oh, where is this?
I'll buy it.
It's like in real life.
Microsoft, Amazon, I think Microsoft.
Market's not like
Microsoft.
I'll buy some Tesla. Tesla.
Oh my god. Yeah, video. It's all
15. It's a good bet.
1 more minute.
Okay.
We got 2 Microsoft.
Tesla's at 8 right now. I pretty much got like.
So we got
I just slowly
I'll buy Tesla. I'll buy Oh, you got I gotta do one.
Or whatever you want.
Oh wait.
I didn't
Can I see the prices?
3, 2.
Better market.
Okay.
I have Microsoft.
Everybody, like count up all your cash and calculate your net worth.
$2.
Incorporating all of this. He's got a whole slew of
93 plus 15. 93 plus 15.
Okay, and then what?
Amazon.
Alpha went to 3 more. How much? I got 90 like blue.
No, that's bad. It was only for 20. That's more than 20. Yeah, you're right. It was 99. Just like
Oh.
You're gonna sell it. I'm like, yeah. I went to Roth and I also bought
That happened. I was over
I
like
guess
this.
so. I don't really know what it is.
there's
The beauty of
that.
It's very Yeah, because I started with it too. Yeah, it's pretty fun.
That's $100.
I moved like 10 minutes.
Oh yeah.
With like just 5
And
minutes.
like the market's pretty.
Okay. Raise your hand if you think that you have the highest net worth out of everyone here.
We're like what?
Okay. What do you got?
121.
Who is better than 121? No, let's just. Okay, I guess we're not winning. Hey, give it over for Billionaire in the future. Okay, let's go around again. Like, could you tell us what your ending net worth was, and what was your strategy in this second round compared to the first round?
We were like what, 160?
160.
Well, so we ended it with like $116, 116, and you know what we did was like we sold a bunch of our stocks because like we were preparing for like a bit of like a bear market. So we sold like we had like 3 stocks left, so we sold everything off.
Okay. Like liquidating, cause like holding cash, like cash won't go down.
Yeah, exactly. Cash stays the same.
Cash stays
but
the same,
these
yeah.
stocks don't.
But in the long run, there's like inflation, right?
Yeah.
You're not good.
I had 117. I kind of just knew it was gonna be very recent.
Oh, okay. Like at some point, it changes. Like there's a point where everything was like, if you can see like here, everything was like around $20, 20 something. But yeah, it kind of just fluctuated. Anybody else? Yeah.
Yeah, like Microsoft was around like 18 something. I sold it for like lower 15 because I know the stocks was.
Okay, so like
I
you
assume.
kind of had like a stop loss.
Yeah.
Like if it went down, like that was an indicator that
Yeah.
like it was
I
gonna go
assumed
down.
because every stock was like around 20, so I thought it might go down like everything.
Yeah. Okay. So some other questions. What were some of your emotional reasoning? What were some of the emotions or reasoning running your decisions? Like, were you trading off of like fear and panic or like greed and stuff like that? Or did you have like a logical strategy? Like, if it hits this certain price, like I'll buy it and I'll sell higher than what I bought it for. Anybody? Yeah, yep. Okay.
Well, I wasn't running, but when I was looking at the chart,
Yeah.
like kind of from my own head, and as it was going higher, I was kind of like, expecting a pullback of some sort.
Mm.
So I would have sold like around, like, another stock, like, when it was on around like $18, I was like, yeah, this
So like when stocks get like overvalued, then you get a little more wary about it's not sustainable in the long run.
This simulator is also a little predictable. You know the cap is $25, so
Yeah.
once it's like around the $20 range, you can start selling and make a profit.
Yeah.
In the real stock market, it's a little tougher because there's never a cap.
Yeah.
So you don't know when the market's gonna go into bearish, so it's really hard to actually time the market.
Yeah, maybe next week we'll try without a cap. But I don't know if I'm
No,
not
no,
for
it's
that.
good, it's good.
Okay, let's see. Did anybody try to like diversify and hold into everything, like a lot of every company? And how did that go? No one tried to diversify? Okay. Did anybody try to set like a stop loss or take profit saying like, I'll buy from you if it hits this price or I'll sell if it reaches this certain price? Cool. Alright, well, hope you had fun. That was our icebreaker. And now we'll go on to the boring presentation stuff now. But I hope you learned something about what it's like trading in the stock market. It can be chaotic. Your like decisions can be run by emotions, like running really high. Like if you panic, like at the end, I know a lot of people were panicking when they saw the whole market like fall. So yeah, for sure. So we're gonna teach you guys today about how to deal with those emotions when you're dealing with real money, because this is just monopoly money. But when you're dealing with real money, your emotions are gonna be way higher. You're gonna be like checking the market like every day, every second to see what happens. So we're gonna teach you how to deal with all of that and how to build proper like rules and like strategies to help you regulate your emotions when it comes to the market.
Well, before we get started, just to kind of gauge who here actively invests. Don't feel left out. And we're probably going to repeat stuff that you might know. Talking about investing strategies, so it's good to kind of take a little bit more of a macro lens. We're going to get a little bit more into like the nitty-gritty, how to get started part. This is just the general part. First to start, you can't invest if you don't know what it is. So what's the stock market? It's basically just buying and selling of shares of companies. It's called stock. Stock, here, stock equals ownership. Essentially, if you own a piece of Amazon stock, you own a little tiny chunk of Amazon's overall company. A little tiny chunk, but a chunk nonetheless. There are two main types of returns when it comes to stocks and stock markets. Number one being dividends, number two being capital gains. For example, a really good way to talk about dividends, we talk about these like regular payments that companies make. UPS. UPS is a dividend stock. At the end of the year, if you own UPS stock, you get back 8% as a kind of return payment. It's basically the company paying you back saying, thank you for owning our stock. Fair enough. Some companies don't offer dividends, some do. The ones that do, you want to factor in. They're usually a little bit more friendly, I guess you could say. Capital gains, on the other hand, is let's say you buy Amazon stock at $200, it skyrockets. I hope it goes to 300, but it goes at 300. You sell it at 300. $100 capital gains. It's the profit that you make when you buy or sell a stock. Ideally, you sell it for more than you paid for it. Returns directly tied to risk. This is just standard throughout all the stock market stuff you're gonna hear. You're gonna hear us talk a little bit about managing risk later on, but it's important to mention that return is tied to risk. That's where these come factor in. How it works, prices are set basically entirely off of prices, supply and demand. Exchanges, so New York Stock Exchange, NASDAQ, Dow Jones, like you used to Dow. We were talking about that. Done all these things, traded daily, matching buyers with sellers. Prices change minute to minute, second to second, actually exactly like in your simulation example. The markets open at 8:30 in the morning and close at 3:30. That's in Central Time. The markets do go off the New York Stock Exchange, which is going to be East Coast time. Really difficult conversion, an hour difference. And in the short term, the market can be, like one could say the pattern for short-term market gain is largely sentiment driven. That can be like, maybe a rumor or something causes stock price to go up a few dollars. In long term, you could say that the market's largely fundamental driven. Like what companies are actually deserving the valuations they get, are their financials sound, anything like that. So with short-term and long-term valuations, you can really drift based on actual value of stock. That's a good term, based on. So as a brief history lesson, we're talking about sentiment. Does anybody know what the Dutch tulip mania was? Does anyone have any idea? There you go.
When people sort of like tulips had this like disease that made it like speckled and
Yeah.
they were very highly prized in the Netherlands and people bought them for a lot of money.
Yeah, exactly. So really good example of like a sentiment-driven market. In the 1630s in the Netherlands, this genetic deformation came up with some of these tulips that caused them to grow what they were calling flames or like specks or different things. It's hard to translate in Dutch. But they called them flames, and they caused normal tulips, which are normally like red, purple, yellow, the whole thing, to look like that. Really pretty, right? Well, they thought so. So tulips suddenly became this luxury status symbol. If you have tulips in your garden and they look like this, you were rich. And if you didn't, you weren't. So you had people on both sides of the coin. You had people like the richest rich and the poorest poor collecting tulips and tulip bulbs. Well, as you can imagine, tulip prices soared. Like I'm talking, you'll see the graph in a second, like through the roof. So you had people that were stocking up on tulip bulbs. I mean, for example, this tulip itself is called Semper Augustus. Semper Augustus tulips, this one here, could be worth 10,000 gil, which at the time was the price of not only a house, but enough money to actually feed everybody in said house and for years. Like I'm talking, you could feed people for a lifetime with 10,000 gil for one single seed of Semper Augustus. Well, as what happens in bubbles for speculation hype drive the market up, people realize, oh my God, we're a house? Are you serious for a single flower? No, and it crashed. The bubble popped in 1637, and the stock price that was so high, and I'm talking like the equivalent of like millions and millions of dollars, just plummeted. People that had been storing tulips and tulip bulbs lost millions and millions of dollars in a day. Funny enough, there's a lot to gain from this. People talk about Bitcoin, sentiment driven and whatnot. This is a classic example of it. Classic example of it. And it further proves the point that markets are not always rational. You might invest in something and think this is a great investment. This is a fantastic investment. How could no one bet against this? And it might drop. You might lose a bunch of money. This is a great example. Here's that graph I was talking about. Up. This way. 1630s. And this is actually, the orange line is Bitcoin, of all things. Bitcoin's still high. You can get into that, but tulips went up, they crashed. Sentiment driven market.
So should I invest in tulips now?
Are you in the 1630s? Yeah.
You touched a little on the New York Stock Exchange and the NASDAQ. I don't know if you're gonna go into this in the presentation, but can you explain like what's the purpose of those different exchanges?
Well, it's the way I've always thought about it is it's connecting buyers and sellers. So it's people whose entire job might be, sitting at the desk and reading out the prices in Johnny's simulation, saying, oh, Amazon's going up, buy Amazon shares. And someone like Pranav, who might have bought Amazon shares when it was $2, might hear that and be like, oh, now I'm sitting on top of the world. Someone who might have just sold Amazon shares for a low price might be screwed. So it's essentially just like, it's a baseline. It's like setting a price in the market. Prices go up and down, changes the next minute. But it's like having a baseline market. Yeah.
So why would companies want to be like on NASDAQ in compared to like the NYSE? Like what's the difference?
Well, I think it's largely off of, if I'm not mistaken, like company identification, like which one better fits your company narrative.
I think like NASDAQ has only a certain few selected amount of stocks in comparison to the New York Stock Exchange. I know that the New York Stock Exchange is much more broader and essentially offers a variety of different sectors within the market. And I know that NASDAQ is more kind of constrained. I think is it more tech driven, I think, right? Yeah. So like, your big Microsoft, Google, all those. So kind of like QQQ if you guys are familiar with that one, but except a little bit more broader.
Tulips thing's crazy. I'm surprised that, I'm surprised that. Yeah, markets are not always rational.
Alright, next we'll be going into building a portfolio. So we'll be starting with like two different strategies. Firstly, like my own like strategy that I use, and then we'll be going over a more like standard with like index fund kind of base strategy. So the first thing that we have to think about when building a portfolio is like what stocks are we gonna choose? What ticker symbols, what names are we gonna invest in? And well, who here wants to like research every single name in any stock market to find out the perfect company and the perfect opportunity? How much time do you think that will take? A really long time, right? So that's where stock screeners come in, because like you can sift through the entire stock market, all the tickers, all the names, and based on the company's characteristics that are standardized. Like I don't know if you guys have taken any accounting or finance classes, but every quarter these companies are required to submit these earnings reports, which will tell investors about the financial health of the company. They'll tell investors about like cash flows, about how much cash they have on hand, how much debt they have. So we can use these numbers that are standardized across all names to figure out which companies are in a good position and which companies are in a bad position. So there are two main types of stock screeners that we use. Like mostly, I use Seeking Alpha, but FinViz is also a great free alternative. So let's just try to show you a little example. So here I already put in the kind of categories and quantitative measures that to filter these stocks. But you can see that like there's like hundreds of thousands of stock tickers, and we boiled it down to 70 stocks that fit my description. And what are these descriptions? So firstly, I invest mainly in companies under $10 billion in market cap. Market cap is basically the total value of a company. So how much market cap is like how many shares are in circulation multiplied by the share price. So the reason I invest in these like companies that are less than $10 billion is because they haven't matured yet. And companies that haven't matured yet have really high growth prospects because they're not paying dividends, but they're constantly reinvesting into their company to improve their future growth prospects. And that's where super performance in stocks come from. And then, so I also have this relative volume over one. And this is mainly to signify like when something big happens in a company, because when the volume is really high and price action volume is like skyrocketing, that means that something big happened in the story of the company. So something like maybe they fired a CEO, or maybe they hired a new CEO, or maybe they announced that they're gonna start a dividend or purchase a lot of shares back. So those are the two main descriptive like quantitative measures that I categorize stocks by. And now we have EPS growth and sales growth. So I think this is pretty self-explanatory, but in companies you want to see that quarter over quarter they're constantly expanding operations. Maybe this is like a retail company that is building new stores, or this is like a tech company that's getting more recurring revenue. So what you want to see is that earnings per share growth is rising quarter over quarter, and sales growth is rising quarter over quarter, meaning that the company is becoming more profitable and they're getting more customers and more money. And so technical. So there's two schools of thinking. There's mainly fundamental, which is like the accounting based and quantitative measures that are in like earnings reports and stuff like that. And there's also technical. So technical measures the patterns of the stock price and uses those patterns to create buy signals about whether or not you should buy. So here I have 4 different kind of technical indicators that work together to tell me when a company is in, first of all, a positive uptrend, meaning that like the company is rising, the share price is rising, and the momentum is there for the company to reach new highs and get higher and higher for you to get like capital gains. So a simple moving average is kind of like, sorry, keep doing that. A simple moving average looks at the past 200 or so days and then finds the average price of that share within those, within that time frame. So we can go to, I know I have, yeah, right here in tools and resources, I have TradingView. And TradingView is a great tool to, first of all, you can find the whole library of technical indicators, and you can also, it's completely free. You can look at at stocks with those indicators. So let's use a stock from this screener. You probably won't recognize any of these ticker names or symbols, and that's because these are smaller companies that haven't made it big yet. So you have to do your due diligence and make sure that you research these companies first before you invest in them. But let's look at OSS, One Stop Systems. So when you open up the stocks interface, you can see that these are my 3 indicators. Well, one of them's volume, and the average volume over 90 days. But this green line here is that, the green line is the 50-day moving average, but the red line is the 200-day moving average, and this yellow line is the 150-day moving average. So when the 200-day moving average is below, like they're stacked on top of each other, and the price is all the way at the top, that means that this company is in a strong, like, upwards trending trend, like a strong uptrend, and that it's likely that this company will go up even more in the future. Obviously, this isn't 100%. There's no indicator that is like 100% that will tell you the exact moment when you should buy and when you should sell. But it's a good way to tell, like, if you look in the long run, where's the company been and where is it going? You can see that in the, at least like in the short term, it's starting to break into an uptrend based on like its long-term historical price and also its recent price.
Johnny, I have a question.
Yeah.
But like, what if I don't have the time to like look at charts all day and look at all the candlesticks and all these different EMAs and all these different charts? Like, what do I do if I don't have like the dedicated time for this? Like, I'm a student, I'm a college student, I'm worried about homework and classes, and I only have like 5 to 10 minutes in the beginning when I wake up just to see how the market's doing, and then I just gotta follow through. Like, what do I do then?
Yeah. So that's a good point. I know a lot of you guys aren't going to spend this much time researching stocks and companies and looking at all these fancy indicators and like stock screeners. But so if that's not for you, there's also a different method of investing where we can buy one index fund, which is a basket of goods of like the top 500 companies in the stock market by market cap, which we talked about. And you can just buy that and hold it, and it will match the returns of the S&P 500. And the S&P 500, called the Standard & Poor's 500, is kind of this reflection of like all the biggest companies in the stock market. And so you don't have to invest in 500 individual companies. You can just invest in an S&P 500 index fund, and it will automatically diversify you in those 500 different companies. And this is a safe investing strategy because, as you can see, in the long run, like I can look at like the past. Oh, that's way too long. But you can see that over time it works. Over time, the market will go up and up and up because the U.S. stock market is known to have around 10 to 12% returns every year. So that means that if you put your money in a safe place like VOO or SPY, these index funds that track the S&P 500, the 500 biggest companies in the stock market, your money will grow over time. Obviously, there's benefits to individual stock picking as well. Like with individual stock picking, you'll be trading on more risk, but with risk, there's more reward, right? So there's a chance for more reward, but it's a little different. If we move on to our next section, in the intro to modern portfolio theory, this might be getting a little too deep into the woods, but when we talk about risk, there's different measures of risk, right? So let me show you. Okay. Let's say we have two companies here. And one company, I don't know if everybody can see this, but let's, yeah.
I don't think everyone can see it.
Okay. Oh wait, let me try to, is there a way I can draw here?
You can go on that board too.
Oh, that board? Okay, that's perfect. Okay. So let's say this is stock 1, and this is stock 2. And these two companies, from the first company, really jagged like this, but it reaches here at this point. And then the second company Nice and straight, but it was zero. Now, which company would you rather invest in, and why?
2.
Yeah, sounds good. What's the reason behind why you would want to invest in stock 2?
I can sleep at night.
Yeah. So that's a good point. So in this case, we would say that stock 2 has less risk and the equal amount of reward, while stock 1 has higher risk, even though it reached the same point. And this is known as the Sharpe ratio. So this might be getting a little too deep into the woods, but the Sharpe ratio is a measure of risk-adjusted return, right? So you have all this return, but without the risk. And that's what you want in a portfolio. And the reason why Sharpe ratio doesn't actually, in its components, in its equation, Sharpe ratio doesn't have the actual share price within its equation. And that's because even if the stock was like this, and it didn't have a lot of return, but it was still straight, you can leverage this. And with leverage, I mean like, you can invest more money into it, you can invest on margin, or you can use leverage products like derivatives or options. So what we're aiming for is basically a portfolio that will be straight like this, without the zigzags. So does anybody know how we can get a straight line like that?
Index funds.
True, but what is the theory behind index funds?
You match the returns of the market.
True.
Diversification.
Exactly, diversification.
Oh.
So diversification, the theory behind diversification. When one company goes up, the other company will go down, and they even each other out, right? So when they even each other out, they create a straighter line compared to just investing in one stock that is zigzagging a lot. And so we call that negative correlation in mathematical terms. But it basically means this stock moves with another stock, or when two stocks are negatively correlated, when one stock goes up, the other stock goes down, and it'll even out. And so that is what gives you a high Sharpe ratio, when one stock goes up and one stock goes down, and you get that straight line. Yep. And then, so moving on to like other tools and resources, you can have, you can read Yahoo Finance. Yahoo Finance is great for market news, market updates about specific things that move markets. And then also with AI, recently, like even this icebreaker, I used AI to code it. I'm becoming like, anybody know Professor Norman Kuo? He uses AI for everything. And I was taken aback, like I completely vibe coded that icebreaker, but it was really successful. So I think that the role in AI in financial analysis is really, really starting to emerge as like a useful tool. So I can explain something like, let's pull up. Yeah, this is me asking for notes about some thought-provoking questions I can ask the audience. But right here, I don't know if many of you know this, but there's multiple different types of GPTs. And we can look for a stock-specific GPT that can help us recommend, like analyze the market and recommend certain stocks. So let's choose this one, stocks, crypto, and for options forex market. And I'll start this chat. And so let's use this stock that it was OSS, and I can ask ChatGPT. Usually, when I ask for a stock report specifically from ChatGPT, I'll frame it like this. I'll say, give me a detailed stock report about OSS,
This is free.
One Stop System, the company, One Stop System, ticker symbol, OSS, and tell me about the company's potential earning prospects in relation to recent macroeconomic events. Explain this such that fifth grader kindergartner
What are you telling about us, Travis?
can understand. Yeah, so I can't spell it, but so you can obviously, I think the most important thing is asking this ChatGPT or any chatbot, like explain it in simple terms that a kindergarten can understand. I'm not saying you guys are kindergarten, but it explains things in simple words, and like you can see that One Stop System is a factory that builds very special parts for fast computers. So that tells me that they're in the tech industry or something related to NVIDIA chips, microprocessors, or stuff like that. So I think that AI in the future and in stock research will have a very big role, and it's a useful tool that anybody can use. I do like them.
Okay. So, whenever we're beginning to invest, you know, we all have an allocation of money, $50, $100, whatever, how much you have. And you might question, where are you gonna put your money in? First off, how do you even begin? You begin your journey with a brokerage account. There's a variety to pick from. A lot of you are probably most familiar with Robinhood. It's the most easiest to use. I guess it's like an introduction brokerage. You can use it on your phone, very easy and interactive. You just put your money in, invest your money and watch it grow or lose. Now, next we kind of have Fidelity, Charles Schwab, and Vanguard. These three are a little bit more technical. They're more easier used on like a computer or desktop. But if you're kind of beginning and wanting to get into it, I recommend starting off with Robinhood. Just kind of getting a feel for understanding how the market works. Once you kind of explore that, you can slowly get into either three of these. I know that Goose has personal usage with Fidelity. You want to give a little bit of tips in regards to Fidelity and your experience?
Yeah, I think the big thing that attracted me to Fidelity initially was when I started really investing and like putting money away for retirement, I wanted to make sure I could invest in a broker that would let me do partial shares based off dollar amounts. And I looked at the other ones, and it's not that, I personally wanted to keep like my own personal investing in Robinhood to like a minimum compared to like a long-term account. And Fidelity really stood out to me. Once again, this is not investing in Brett, not investing in Brett. With that said, largely because I could buy partial shares in companies or like ETFs. So if I didn't have $500 lying around to put away for retirement, I could put $20 away for retirement. Or, oh, you know, maybe I got more tips, or I want to put $50 away for retirement. And I could buy, you know, maybe a tenth of a $500 ETF. So for me, at least, Fidelity was one that I really liked. I've had no issues with it. I'll stand by it just because I enjoyed it. You know, people that invest with Schwab, Vanguard, or even put their long-term stuff in Robinhood, you really can't go wrong. I just personally really do like Fidelity.
Thank you, Bruce. I personally have investments in with Charles Schwab. I started off with Robinhood, and I kind of wanted to explore different types of accounts. I know that initially Robinhood didn't have any retirement accounts, and that's kind of why I switched over to Charles Schwab. Because if you guys are familiar with different retirement accounts, like a Roth IRA, where whenever you put your investments in, and whenever they grow, they actually grow tax-free. So by the time you retire, all that income that you generated is not gonna be taxed. All the dividends that you earn are not gonna be taxed. So if you earn like $100 grand within that account by the time you're 66, you take it out, you're gonna have $100 grand in your pocket. That's the best thing about that account. Another thing with Charles Schwab is that they're a little bit more technical. However, they have a large variety of different, I guess these called like pies or slices. So if you have like interest in, for example, tech, you can look up tech, and they have like things that are dedicated to just cloud computing, or things that are just like maybe browser search like Google or Microsoft, so on and so forth, and do healthcare and all these different kinds. That's kind of why I'm a big favorite of Charles Schwab. Now kind of talking about Vanguard, not too many people, I mean it's still well known, but it's not the most familiar with. It's actually more based on like these ETFs or these index funds that are actually low fees and low base. So a little bit of like a side lesson here. All these ETFs and index funds and mutual funds, they all have some sort of fee. Now reason being is because there are individuals that are actually managing some of these funds. Now, with these funds that are being managed, you have to take a little bit of a commission whenever you're making these trades. Now over time, some of these do accumulate. Like for example, mutual funds, they're actively managed in regards to like index funds or ETFs, which aren't. They're like more so passively, so it's like they just put those stocks in a certain group and they just leave them. So the fees are like, I think it's like 2 cents or something every single year. So not really much in comparison to like a mutual fund, which is I think is like 50 cents or 30 to 50 cents per year. So it kind of compounds over time based on how much you put into the market.
Yeah, if I can add 2 seconds on that. All of these pretty much do the same thing. They're all super easy to open. As long as you have a social security or an ITIN, you can open one. Robinhood, super easy to use. If you're just getting started, they give you like $5 free. I know when I started, that $5 was appealing to me. Now it's just $5. If you don't have a lot of money and you want to get started, Fidelity is perfect to use, as Brendan suggested, you can do stock splits, or fractional shares. If I only want to buy $20 of Apple, I can buy $20 of Apple. On Charles Schwab, that's not possible. I use Charles Schwab, and the reason I like it is because they give you access to so much information. For every company, say Apple or Microsoft, they'll have like 5 designated reports just for that company. It's super helpful because you get to see an analyst's perspective and their buy, hold, sell recommendation on that company. So I'm saying, oh, I don't trust myself, I don't know anything about finance, let me just trust an analyst who's done this for 20 years. So that's a big pro for Charles Schwab or Fidelity that Robinhood doesn't offer.
Thank you, Sasha. And then one kind of thing, just a small correction. Whenever you said that Schwab doesn't allow for fractionals, they actually do allow fractionals, but only on individual stocks. But like your high-end ETFs, like
Only on S&P 500.
yeah, only SPI.
I have a question. So let's say someone who just like doesn't want to look at market that much and like just wants to invest, and do you think like just Robinhood or Fidelity just like one of the great options, not like switching back and forth between brokerages?
I mean, I personally keep all of my money in one of these brokerages, unless if you have like something on the side, like before I had like a Robinhood account and Charles Schwab, and I used my Robinhood account for like more riskier stuff, and I use like a smaller amount, and then my concrete like investments, I kept all of that in Schwab to keep it more organized and for myself to kind of do, but depends on your investing preferences.
Yeah, I just had a question, you know, kind of what you said, like a beginner friendly, say like if you had like no experience at all, but you want to make like a lot of money, just like want to make big bucks, like which one will like teach you, have like a guide for you, like let's say like, you know, which stock to invest in or how to like even use one of these accounts?
Yeah, good question.
As a thing to say on that, I mean, that's where this gets a little bit difficult necessarily, because you might want the reports of like a Schwab, but like the nice ability to invest in like, you know, partial shares of ETFs. So it's kind of to each their own. I think that was what really attracted me to Fidelity. This is not an ad for Fidelity, they don't pay me. I know you guys work for Fidelity, please. But that's why I liked Fidelity, because when I first got into it, it was like, well, you know, there's all these resources online, and I can see, you know, YouTubers that are doing like really, really in-depth analyses of like all of these stocks. I want something that can allow me to like build up slowly. I felt like Fidelity was that, personally, because there's so many resources online where you can just get really in-depth analysis of people whose jobs is to do it.
Yeah.
I like that also. We've also included this as well for anyone that needs to leave early and just wants to know how to invest for retirement. ETFs, for sure. Mutual funds, index funds. This is like a good baseline. It will build wealth over time. You really just need to find a brokerage you're comfortable doing it with.
Thank you. And I think you have a question too.
Oh, I have a question. It was more of a response to the question over there. I use 2 brokerages, Fidelity and Charles Schwab, but for it to be like centralized, I use Yahoo Finance, which can connect you to both your brokerages. So.
And what was your name, remind me?
Matthew.
Matthew, thank you, Matthew. Appreciate that. All right, if you want to move to the next.
Moving on. So let's talk about risk management. I'll be short because I think we're running out of time with this. But so I believe that you can succeed with any investing strategy. Like you can buy literally anything if you have good risk management. Because risk management is about limiting your losses and letting your profits run up. So like when you're wrong, like we're all gonna be wrong, and I'm gonna be wrong. I've been wrong thousands of times. Like even if you're wrong 70% of the time and you're right 30% of the time, if you have good risk management, you can still generate a profit. So it's really important. And I like this philosophy. This is from one of my favorite books about investing. It's called How to Trade Like a Stock Market Wizard by Mark Minervini. And the philosophy is basically like, by keeping a really tight stop loss, if you go down, you're dying by 1,000 cuts. You have to be wrong 1,000 times in a row for your account to like reach zero, rather than going down by one big blow. And this relates to another one of my favorite books, The Psychology of Money by Morgan Housel, if anybody's read it, but Investing for Stamina. Because as we saw, like if you invest in a long-term mutual fund like VOO or SPY, something like that tracks S&P 500, if you invest for the long run, you're gonna make money and you're gonna make a lot of it. So, about my tips for risk management. First, there's 2 types of stop losses. There's a flat, like straight stop loss, and there's a trailing stop loss. So I can draw it again, but I'll just try to explain it in words. So a flat stop loss is just a stop loss that will stay at a certain price no matter what. So no matter how the stock moves, if it reaches that initial stop loss, it'll be sold. And a trailing stop loss is a stop loss that you can set trailing from a certain percentage or a certain like nominal dollar amount. But as the stock goes up, the trailing stop follows it. So if I start at like a stock with like $100 a share and I buy it at $100, if it moves up $10, the trailing stop loss will follow it. And so what I recommend is, first of all, to set an initial 7% stop loss. I think this is a good baseline to make sure that you don't like lose everything, but also to make sure that you have enough wiggle room to see that if the stock is going up and your hypotheses were correct. And then after the stock moves up a bit, say it moves up to 5 or 10%, I like to set a 10% trailing stop loss so that in the case that something in the story changes, like the company releases some really bad financial information, you'll be out of there even if you didn't know what really happened. So I think those are two good ways to manage your risk and make sure that even if you're wrong 70% of the time, you can still make a profit in the stock market. Oh, sorry.
Alright, so kind of moving on to an important individual that played a really big role in the whole market and stock exchanges and buying and selling. It's actually the individual that founded Vanguard himself, John Bogle. Now, John Bogle has a very interesting philosophy when it comes to investing. You want to start at the end. Like, what is your initial goal? A lot of us might be thinking, oh, I want to make money. I want to make money enough to be financially free and all this stuff. But none of us are actually considering the long-term effects. So, for example, for me, I might want to retire when I'm 55 years old. And then you slowly work your way back to where you currently are. So it's like, maybe at 30 years old, I want to be by X amount of cash. And I'm going to think, how am I going to get to that amount? Am I going to be diversifying in like these solid ETFs? Or am I going to be going a little bit more riskier based on my risk tolerance and how much money I'm willing to wager in those individual more riskier stocks? So he also has a lot of this core investing principle where you want to start with a goal and then build backwards. So for example, kind of how I said, in retirement at 50, what returns do you need? How much money do you need to save from like your paychecks that you're earning from your jobs? And how much money do you want to be saving by the end? How much money are you spending on things that you don't necessarily need? I know a lot of us like not even thinking about it, go up to a vending machine and buy a snack, but we could have waited a little bit home and then got a snack at home, for example. And those little things compound over time, and that could save you hundreds for just a week. And you could be putting that money somewhere in a safe place where you're actually making more money. So now we have a little bit of a definition. So I know there are a couple of individuals here that asked me about day trading and like weekly tradings and so on. But in my personal opinion, that's a little bit more on the riskier side, but obviously that's kind of up to you if you're willing to wager that money for yourself. I personally side with the investor side. Now, what is the difference between these two? A trader is someone that looks for short-term growth. They're willing to make a quick buck or trying to make a quick buck. It's a lot more riskier, it's a lot more volatile, but you're actively sitting at your computer. You're sitting there essentially all day checking the markets. Is it up? Is it down? And you're worrying about so many different things. And in my opinion, when I was doing this back when I was younger, this caused so much stress for me. I was sitting in class trying to trade, and my grades kept falling. And obviously, that was not a good track for me. So I started following through with investing. You know, it's long term. It's year over year, even decades. And you buy and you hold. I know there was a big topic on diversification, but also you don't want to be too diversified either, because if you're too diversified, you're not actually implementing growth for yourself. So Warren Buffett made a bit of a topic, or I guess like a point here, where you want to pick 6 to 7 stocks that you have confidence in and did your research and your due diligence, but you know that for the long term, they're actually going to improve and create an impact. And you want to hold those 6 to 7, not having 10 or 20, because if they increase by a little bit or increase by a good amount, you don't have that much allocation or cash within this. You're not making as much as you could have been if you just invested like another amount within that one individual rather than spreading it across multiples. Now we come across a couple of investment mistakes. I don't know if I want to keep your guys' time, so if you guys have to go somewhere, you guys can feel free to leave. It's 7 o'clock. If you guys have any questions, I think you can email one of us personally. We'll get right back to you. But if you guys have to go, thank you for for coming out to our meeting. If you wish to stay and learn a little bit more when it comes to making mistakes or investing, feel free to stay. Up to you guys.
Yeah, we'll hang around to answer some questions, and we can pick up next week on this if you guys want. Next week we will be talking about career paths in finance, so whoever's very specific to finance, next week's for you. Even if you're not, you can still come and join. We'll also be going a little deeper into what we didn't cover today. We can physically show you how easy it is to open a brokerage account, or even buy a stock, buy an ETF. We can do some walkthroughs, if that's what you're looking for.
As a final thing too, for anyone literally just looking to invest for retirement, please take a picture of this. This is like literally the baseline learning. That book that Johnny said, Psychology of Money by Morgan Housel, is maybe the best case for ETS, index funds, and mutual funds. So if you don't know what it is and you don't really understand it, and stock pie and stock smoothie, like all those things talking about ETFs, just kind of goes over your head, that's completely okay.